My name's Alan Finnis, and I'm a Director in Audit and Assurance and Financial Reporting Accounting Advisory Services at William Buck in Melbourne. And today's session should hopefully be informative and also kind of a brief understanding in terms of how we account for business combinations. So just as an introduction, today's discussion will focus, as I've previously mentioned, on business combinations. As we all know, the last 6 months have been challenging, and you know, for everyone that's still out there and kind of progressing through work environment during the past 6 months has been very challenging. But having said that, there are a number of opportunities that we can take advantage of, which may lead to, you know, the growth of your business. So the session will run for about 45 minutes. So feel free to ask questions throughout. There's a Q&A function in the software. So please feel free to reach out and we can kind of address them as we go or at the end. If you do have any questions, you can email me directly at alan.finnis@williambuck.com, and a copy of the slides will be distributed at the end of the session. So it is 11:03, so let's get started. And I do note that Daniel Andrews did go out at 10:15 this morning, so he obviously doesn't want to compete with us. So here we go. All right, so the first thing I really want to touch on is a definition of a business. So one of the things that has happened recently, and it has become applicable from 1 January 2020, is the definition of a business has actually changed slightly. AASB 3 came out in the early 2000s when IFRS was kind of released, and there hadn't been that many changes to it up until kind of December 2018 when the AASB released amendments to Australian Accounting Standards definition of a business. Now, the whole purpose of this kind of amendment was to make some slight changes to the definition of a business and make it easier for kind of business people, accountants, professionals to kind of understand in terms of you know, whether we've got a business or whether we've got an asset acquisition. And that's what we'll really touch on in the first part of this session before then getting into the kind of the nitty-gritty of how we actually account for these things. So the amended definition of a business is set out there on the slide in front of you, which is an integrated set of activities and assets that is capable of being conducted and managed for the purposes of providing goods or services to our customers, generating investment income, or generating other income from ordinary activities. So that's what they've basically suggested that the definition of a business is as at now, and we'll get into a bit of detail as we go forward as to what that exactly means. So as I said, this has now become applicable from 1 January this year. So we are in play with this as at now. So the key outcomes from the minor change here in the standard word, the definition of a business has become slightly narrower. So what this means is you're more likely than you were previously to have an asset acquisition. And as we go through, I'll explain kind of the benefits of a business combination against an asset acquisition in terms of, you know, for example, goodwill, transaction costs, deferred taxes, contingent assets, and contingent consideration. Judgment is also required in determining whether a substantive process exists, and they've also introduced what's called an asset concentration test, which makes it a bit clearer as whether you've got an asset acquisition or a business combination. So this is how diagrammatically that the AASB now presents a definition of a business. So as at a minimum, we need to have an input and a substantive process which significantly contributes to create an output. So obviously, if we've got, you know, we buy a trading business, you know, that might sell, I use the example of a winery. So for example, you know, you'll buy the land, the vines, the processing center, probably the employees and the winemakers that kind of come with that, and that will obviously create your wine. So effectively, you've got a business because you've got inputs, you've got substantive processes, and you've also got outputs, being the wine. So one of the things that we need to kind of consider is not all businesses do have outputs. People might buy business, well, organizations or potentially assets which are in kind of developing industries, most likely in technology, life science, or mining, whereby, you know, whilst there's activities going on such as inputs and processes, there's not necessarily outputs. In the example of, you know, a technology company, the technology may still be in development, or likewise with a mining company, you know, you might have a tenement to go and explore a particular area, but you might not have actually got to the point where, you know, you've put together a mine plan or, you know, been able to start extracting the minerals. So when we kind of look at this, inputs are quite easy to determine. So, you know, obviously we've bought a tenement, or we've bought, you know, some intellectual property, and outputs are also likewise quite easy to determine. So, you know, we've got either a piece of software, some wine, or any other kind of output that you would sell in the normal course of business. So the real critical part here is in relation to the substantive process. So we do have on the next page here a bit of to help us understand kind of whether we do actually have a substantive process and meet the definition of a business. This flowchart kind of helps us get to that point. So if we're looking at a process, and again, if we use the example of a winemaker and how they kind of produce their product, the first question there it asks us, is the acquired process critical to the ability to develop or convert an acquired input into outputs? Well, quite simply, you know, if we don't have, you know, the ability to actually manufacture the wine, take the grapes off the vines, process them, we don't have a substantive process. So effectively in that situation, you know, the vineyard that we bought, it would just be an asset acquisition of the vineyard. Having said that, if we do have the processes acquired, such as the recipes of the wine, etc., we can move on to kind of step 2, which states, do the inputs acquired include an organized workforce that is highly skilled, knowledgeable, or experienced to perform the acquired process? So this kind of comes into what I was saying previously in relation to the employees being kind of taken on as part of the acquisition process. So sometimes you might find, you know, if you go back to the wine example again, the employees may be wanting to retire, or they may want to just exit the business for other personal reasons. So on this basis, you know, you're then going out and have to find your own workforce, etc., to kind of bring into them, which would be separate from this business combination. So again, you wouldn't have that substantive process, and you'd just be left with an input. So again, it would form an asset acquisition. If we do have the workforce, we can then move to the third step, which says, do the inputs acquired include other inputs that the organized workforce could develop or convert into outputs? So effectively, they can develop the recipes, the vintages, etc., in the wine, and we have a substantive process. So in that case, even if we're not actually, if the vineyard is in its infancy, for example, we could say, you know, we do have a substantive process because we have all the building blocks there to actually get to a point where we can start making the wine. If I went back to a mining company, obviously we don't have a substantive process here, because if we're into the situation where we're just acquiring a tenement, for example, you know, we obviously don't have a workforce, we haven't developed the processes yet, and we're not physically able to convert that tenement into an output at this stage, because obviously it's purely a tenement, we're just exploring. Having said that, you know, within the mining industry, you know, there are obviously in the larger kind of scale acquisitions, you do get business combinations where you would have, you know, a mine plan in place, and you may not necessarily be in extracting minerals, but you may be in a position where we do have a substantive process. So there is an element of judgment, but it does define and make the whole thing a little bit clearer in terms of, you know, whether we've got that substantive process which constitutes a business. So the next thing I wanted just to talk about in the other main significant change of this amendment to AASB 3 is in relation to the asset concentration test. So the AASB have come out and they've said, okay, you know, if we've got an asset, if we're acquiring something which is purely just one significant asset, more likely than not, we've got an asset acquisition and not a business. So an example for this is really in relation to kind of property, to be quite honest. So say, for example, you buy a portfolio of properties, maybe apartments or, you know, townhouses or such like. You might find if they're all kind of similar townhouses or similar apartments and there's not much else coming along with the acquisition, then you've got an asset acquisition of these townhouses and buildings as opposed to, you know, a business. So the concentration test again does apply judgment, but it is a lot clearer to kind of ascertain whether you've got an asset acquisition or a business combination on the basis that, you know, if you're making an acquisition for say $10 million, and you know that the property within that is, you know, $9.8 million, chances are that you don't have a business and you've just acquired an asset. So those two are the really significant changes that have occurred within AASB 3 over the past 12 months, and they'll all be applicable now for June year ends this year. So from 1 July 2020 for 30 June year ends ending June 21, this standard and amendment will now be in play. And for December year ends, it's already been in play for this financial year since 1 January when it was released. So the next thing I just wanted to talk about is really just when we're defining a business, I just wanted to talk you through the benefits of a business combination versus an asset acquisition. So when we've got a business combination, and we'll go into a calculation further down the road in this webinar, but in terms of a business combination, quite often we end up paying a larger sum of consideration than the assets that we're acquiring. So what this generates usually is a goodwill on the acquisition. And one of the things that you need to bear in mind when you recognize goodwill on your balance sheet is then you are in play because you do have an indefinite life intangible asset, which would require impairment testing on an annual basis. And obviously that's quite an increased risk of compliance for the business, and it's something that you would have to build into your processes going forward. So if you haven't done a business combination previously, you don't have the goodwill on your balance sheet, this would be something new that you'd then have to go out and do. With an asset acquisition, there isn't any goodwill, and all the value is held within the respective asset. The next one's a big one, the transaction costs. So these can be quite sizable. And it's not just transaction costs, it's related taxes as well. So say, for example, when you can see there in the slide that transaction costs from a business combination are expensed through the P&L as they're incurred. Whereas with an asset acquisition, you can actually capitalize the transaction costs into the value of the asset. And this is particularly important when it comes to purchasing property and stamp duty. So when you acquire kind of a land and building, you can actually capitalize the stamp duty along with the asset, which would be helpful. So a lot of people, what they do is if they're buying a business which includes property, plant and equipment, they sometimes structure the deals. So effectively it forms two agreements. So there's an agreement to acquire the land and buildings as an asset acquisition, and then there's a separate agreement to acquire, plant and equipment, employees, etc., which is a business. So they effectively split the business combination into two parts and structure the contract in that way. So they would have two separate contracts effectively. And this basically allows them to capitalize the stamp duty costs which are associated with the asset acquisition, which would be the main component of the transaction costs if you're acquiring property. With deferred taxes, now this is an interesting one. So on a business combination, deferred tax assets and liabilities arise if the accounting base is different from the tax base. So if we acquire employee provisions, or there'll be a key one where we obviously generate a DTA. So there is some kind of deferred tax accounting required if you do have a business combination. Whereas with an asset acquisition, there's an initial recognition exemption. So the accounting base would equal your tax base, so you wouldn't get a DTA or DTL on an asset acquisition. So it does make things a little bit more straightforward. In terms of consideration paid in shares, so there's a slight difference here again as well, as the measurement under a business combination is the date of the shares, that the measure of the fair value of the date control is obtained. So if we're issuing shares, if our share price is $1 and we issue, 1 million shares for $1 million, that's basically the value of the date that the control is obtained, and that's what we'd record as our consideration, which we'll come on to shortly. Whereas with an asset acquisition, we actually value what the asset is worth. So it's slightly different in that respect. In terms of contingent consideration, we do have contingent consideration on a business combination, and this effectively relates to consideration that is due based on significant events that may occur post acquisition. With an asset acquisition, we don't generally recognise contingent consideration on the basis that the accounting standards stipulate that. So say, for example, on an asset acquisition with regards to a mining company, you might find that shares are issued to the vendors in stages. So for example, you might get 20% of your consideration once the exploration license is granted. You might get another 30% when a JORC resource is confirmed, and then you might get the remainder when extraction starts. So effectively, on the acquisition date, you would only recognise the 20% and probably disclose the additional as a contingent liability, but you wouldn't actually physically record that until the event has actually occurred. So it does make a bit of a difference. Whereas with a business combination, you recognise that consideration all on the acquisition date based on a probability of it being completed. And we'll get into that and how we account for that shortly. So that's basically the definition of a business and how we kind of get there from the inputs, substantive process and outputs, and also the asset concentration test, which is now in play, and a brief description there of the differences between a business combination and an asset acquisition. So I'll continue through the presentation now and get more into the actual accounting for a business combination. So this assumes that we don't have an asset acquisition, and from here on out, we're talking about business combinations 100%. So when we do sign an agreement to complete an acquisition, these are the things that we tend to really see within the agreement, and these are the key details that people look out for, what I look out for as an auditor, and you know what you guys just make sure that you've got 100% locked down before you complete anything. So obviously the counterparties and their authority, the date of the sale of the agreement and the completion date, any kind of conditions precedent that are included, the actual consideration, whether that be cash, shares, working capital, and we'll come into that shortly. Details of the assets transferred on completion, and any kind of warranties that you kind of oblige to, such as, you know, warranty provisions for kind of historical business activities that occurred prior to you purchasing the business. So in terms of the consideration, these are the things that generally form consideration. So obviously cash consideration. So people, you know, you wire the money and the business is yours. Some people issue scrip as part, either completely or just as a proportion of the deal. There's also a working capital adjustment, which I'll go on to in the next slide. And then we'll also get into the deferred consideration versus contingent consideration, performance goals, but continued employment is not necessary. And this is something that I want to talk about because there's an issue here in relation to whether something meets the definition of consideration or remuneration. So this can have quite a significant impact on your accounting for the business combination. It's important that, you know, you get the contract written up to a level where you can kind of get the outcome that you want. So the working capital adjustment, now this is something that I wanted to kind of touch on briefly as well. So working capital can be defined in the agreement, purchase agreement, kind of at the vendor's choice, really. A typical one is you're acquiring the accounts receivable, the inventory, and you're kind of subtracting the accounts payable. So say, for example, you've got a target working capital of $1 million. Perhaps, you know, you've got accounts receivable of 2 million, you've got inventory of 1 million, and then you've got accounts payable of 1.5 million. So if you do those numbers in your head, you probably get you get to a working capital of 1.5 million. If our target is 1 million, then that tends to suggest that about 500K there would be an additional payment to the vendors, which effectively means you would have to go out and you know, pay an extra 500 for that working capital. Whereas if it was the other way and the accounts payable was, you know, took you to a position where your working capital was 0.5 million and your target was 1 million, then effectively you get that money back from the vendors by way of a discount. So it's an important thing to work out. And one of the things here that comes into play is quite often when people do business combinations, if the larger company is, say, for example, an ASX listed business, it might go and acquire a private entity to kind of build into its business. The private entity may not have the same level of compliance kind of reporting structure as the acquirer. So it is important to make sure you do your due diligence fully, whether it be due diligence or full audit. In terms of how we kind of, you know, assess to make sure that what's actually being acquired is accurately correct. We can assist with that, both in due diligence capacity and also through the audit capacity as well. So if you need anything, please feel free to reach out. As I said, the working capital adjustment is based on specific criteria, which, you know, is determined in the agreement, which is really drafted up by the parties. So that's basically what I wanted to cover on that. So the next thing that I did touch on this briefly was just the argument between consideration and remuneration, and this is quite a large risk. Oh, we've got a question. I'll just come back to that in a sec. Okay, so we'll just let cash-free, debt-free. Yep, I mean that's interesting. That's an interesting topic there, Tony. I'll just come back to that on at the end if that's okay. I'm just going to run through this consideration through remuneration argument, and then I'll touch on that. In terms of this factor, so basically one of the things you need to consider here is when we're talking about consideration versus remuneration, it comes into the contingent consideration argument. So if we have employees that are kind of were previously vendors and are becoming employees, there's a risk that any kind of amounts paid to them, which are part of the business combination, could actually be created as treated as remuneration and have to go through the P&L on an annual basis rather than being included in the consideration amount. So obviously, if you've got kind of a deferred consideration, contingent consideration arrangement going on for 3 or 4 years, this could have a sizable impact on your profit and loss, and it's important to make sure that you work through this as part of your process. And ideally, we want to get this value in the consideration amount and not having a P&L hit every year in respect of the remuneration that paid to the party. So we've come up here with a flow diagram which kind of just identifies whether we've got consideration or remuneration, and there is judgment that is required here, but in general, this is kind of where we kind of land. So the first step one, obviously, if there's no shares or cash payments to selling shareholders, there's obviously no further analysis required because you don't have any, additional payments required. So if if the selling shareholders are providing services to the buyer post-acquisition, we move forward to step 3. If they don't, obviously it's consideration. So once we get into kind of some of the criteria for deferred and contingent consideration, you can see whether or not we're in that kind of position. So then step 3 comes down and it says commercial substance of payment arrangement explicitly implies required continued service. So quite often, in order to kind of avoid the argument there in respect of continued service, it needs to be kind of stipulated very clearly in the agreement that the vendor isn't required to work there. If they work there through their own choice, then that's fine, but it needs to be clearly stated in the agreement. And this is kind of some clients, and not clients necessarily, but people in organisations who have done these business combinations have ended up kind of getting to a point where they've got remuneration, and it has hurt their P&L, and it's not a true reflection of the business either. So it's important when you're writing these agreements to make sure that you kind of assess this, and any kind of future requirements need to be taken care of. So I will just go back to Tony's question. So any thoughts regards cash-free and debt-free? In terms of what we've seen in the market at the moment, and probably Tony would actually be a great one to kind of give you that kind of what his thoughts are and what he's seen as well in the market. But from what we've seen at the moment, the banks obviously are very tight at the moment. They're not really looking to kind of pass on, financing at the moment, just with all the uncertainty. So a lot of the things that we are seeing, they are kind of cash transactions. We're seeing a lot of activity in the markets. Like a lot of our clients at the moment have done sizable capital raises on the ASX, which is kind of to forward their growth strategy, and that's what we would kind of see going forward. The share issue. The share consideration is a good argument, and it really just depends on the specific nature of the business, really. I mean, if you feel that, ultimately it's about control. So if you start issuing shares, there's going to be an element there of, how many board seats am I going to have to give up if I give these shares away to the vendors, and that kind of thing. And that can create kind of just the decision-making process, really, in terms of what people want to do. What I would say is, as I said previously, the cash isn't that available at the moment, so it might be an avenue to kind of get a deal done by issuing script. Sorry, I'll just change the slide. So deferred consideration versus contingent consideration. So deferred consideration is a payment that has to be made after a designated time period post-acquisition, whereas contingent deferred consideration is a payment that's paid only when specific criteria are met. So how do we account for these? So this is basically an extract from AASB 3, so I'm not going to read that, and we'll just get into the details of how we deal with it. But in essence, there's three main ways that we can do this. So effectively, contingent consideration is usually based on specific targets that the business has to achieve post-acquisition. These can be related to profit, EBITDA, predominantly measures, and the likelihood of contingent consideration being recognised is estimated by management. This is usually including a critical estimate and judgment in the financial report. And in terms of kind of the classification here, it's done in accordance with AASB 132 for shares. So the types of considerations we can have are cash, a variable number of shares, or a fixed number of shares. Now, in accounting for this, cash is measured at a financial liability, as is a variable number of shares. So what that means is effectively on each reporting date, say for example, the EBITDA targets are based over a 2 or 3 year period, we'd effectively assess whether we're going to meet these targets, and if we're not, we're allowed to basically release that contingent liability. So contingent consideration rather. So the financial liability, which we record on acquisition date, will be sitting in our balance sheet as a current or non-current liability. If management deem that we're not going to hit that as at the reporting date, then we can affect, or a portion of it, we can release that back through the P&L. It doesn't go against goodwill. It goes through as a benefit, and then you would assess your goodwill for your annual impairment test, which you're required to do anyway. In terms of the variable number of shares, because under AASB 132, the variable number of shares don't have any characteristics that are similar to equity. Because there is a variable number of shares, again, it is measured as a financial liability, and again, we measure that at reporting date. Where we're obliged to issue a fixed number of shares, we actually record that directly in the equity reserves, and we don't remeasure that throughout the period of the contingent consideration in accordance with the standards. The only change we would make to this is if, dependent on whether the target was hit or it was missed, we could basically reclassify the equity balance out of the reserves, either into share capital if the shares were issued, or back into retained profits or / accumulated losses if the shares were forfeited as a result of the target not being met. So they're the kind of key distinctions there when it comes to contingent consideration. I think that the most standard one is obviously the EBITDA target. People like that, but I would say as some advice, if we are going to put together an agreement with an EBITDA hurdle, it needs to be very specific and make sure that you call out any specific one-off items that may kind of impact the calculation. So you don't want to get hit if you are a vendor and you're selling. You don't want to be in a position where your EBITDA takes a hit through no fault of your own or specific one-off item, and then you end up losing, your consideration payment. So that's just something to bear in mind. So the calculation of goodwill. So this is kind of just getting into the more nitty-gritty of the actual calculation now when we go and do a business combination. So as part of the acquisition process, on completion, the acquirer will gain control of a variety of assets on acquisition date, and these can include many things. I've just listed a few up here, which are the main ones that we tend to receive, being trade receivables, inventory, property, plant, and equipment, trade payables, and employee provisions. So the difference between the consideration paid and the fair value of assets will be taken to goodwill. So if I move on to the next slide, I've got a very simple example here. So we can see here we've acquired receivables, inventory, plant and equipment, trade payables, employee provisions, and we've got a total fair assets there of 25 million. We paid 40 million, so therefore we've got a goodwill of 15 million. So that sits on our balance sheet, and within that 15 million, we may have some identifiable intangible assets, which we can do a fair value on, and I'll come on to that in kind of the last part of this presentation. The alternative here on the next slide is effectively, if we acquire $25 million of assets, but we've only paid 20 million, we've actually got gain on bargain purchase. So the gain on bargain purchase is effectively, it's not negative goodwill, but it's effectively, we've got a great deal on our business combination, and we can take that gain directly into the profit and loss as a gain. So quite often this tends to happen, and I have seen it happen in the past, mainly when we've done acquisitions of where there's large amounts of property, plant and equipment. What tends to happen is a price is agreed, the vendors are happy, everyone's sold, the consideration's been transferred, and then the acquirer tends to get an independent valuation done of some of this equipment and the property. And what it turns out to be is that it was actually the independent valuer is coming out of a higher value than what they've actually paid. So that tends to be the main time that I've seen a gain on bargain purchase. It does also happen in terms of intellectual property and trademarks and design and formulas, etc. But that is harder to obviously independently value than, you know, bricks and mortar and equipment. So that's kind of where we land with the gain on bargain purchase. So it's obviously a nice thing to have if you can get a deal over the line and you've got a gain there. As I was saying previously, in identification of intangible assets. So when we've calculated our goodwill number, so say for example we had that 15 million of goodwill previously. There's also an opportunity to identify specific intangible assets and reclassify them out of goodwill in your balance sheet. So effectively, once you do your initial calculation and you work out, say my goodwill is 15 million, you then go and perform an exercise if there are any other intangible assets which really should be separated from the goodwill. And I've listed a few examples here. So licenses and tenements, brands and trademarks, patents, formulations and processes, customer lists and relationships, and development costs. So there is an element of judgment here because some of these intangible assets amortize and some of them don't. So obviously if you've just got pure goodwill, it doesn't amortize and you do your annual impairment tests each year, but do bear in mind if you do split out some of these intangible assets, you will end up having an amortization charge each year. So if you look, for example, licenses and tenements, obviously licenses, you know, are recognizable under AASB 3 and 138 as well, the intangible standard. So in terms of the licenses, you know, say for example, you've got a gaming license with the New South Wales government or the Victorian government, which lasts for, you know, 30 years, you'd amortize that license over the license period. Having said that, if you've got an export license which has an indefinite date, then you wouldn't actually have to amortize that because there's no end date to it unless you choose to terminate it. So you would just carry that license at its value indefinitely, or until you stop until you stop generating revenues on that license, and then you would actually impair it. In terms of the brands and trademarks, again, you wouldn't really amortize them because, you know, brand name, you know, strong brand names, you know, last a lifetime, and we wouldn't generally amortize them. The patents, we tend to amortize them over the life of the patent. With the formulations and processes, this is an interesting one, and some people choose to amortize these, and others choose to so I'm just checking a question here. Some people choose to amortize them and some people don't. It really just depends on the process. In terms of, you know, if you've got kind of a high technology process, you might find that you'd want to amortize that on the basis that, you know, it could be superseded quite quickly. Whereas if you've got a formula for, you know, a cosmetic or, you know, a food recipe or something that will intentionally last like a significant portion of time, then you probably would hold it without amortizing. So I do have a question here. It was about domain names. That's an interesting one. So that's a very interesting question, and I think some people with domain names, there is some value here, and we have done some work on this previously. And we did find actually there is the issue here with domain names is it's about determining whether there's an active market or not. We have had independent guidance that we can determine an active market for them, and as such you can treat them as a separate identifiable asset, yes. So I hope that answers your question there. In terms of the customer lists and relationships, so you might find that you've got a book of clients and, you know, which you've acquired on acquisition, and relationships probably tend to last between about 7 and 10 years. So, you know, we tend to amortize them over that kind of time period, really. Development costs as well would amortize. So with development costs, obviously we shouldn't be capitalizing anything for research. under AASB 138. So it's only development that can be capitalised. And in terms of that, we would tend to amortize that probably over a 3 to 5 year period, depending on the type of development, whether that be technology or life science, pharmaceutical, etc. So they're the main ones, and it was a really good pickup from the guest there, participant there, who mentioned domain names, because that should be on the list as well. Sounds good. This is a lot of text, so I've just put this on here because it's one of the most important parts of the standard. And when you do complete a business combination, you can see the last sentence there I've highlighted in bold, and it says you basically get 1 year to finalise your accounting. So sometimes, if I go back a couple of slides, it's quite easy to get to this point. So it's very easy to kind of work out, yes, I've got trade receivables, yes, I've got inventory, yes, I've got plant and equipment, payables, employees, and we can work out what our goodwill number is. Sometimes a little bit more work is required in this section to work out, what's the value of our licenses, what are our brands and trademarks, customer list, relationships, development costs, etc. So these are the kind of things that do take longer, and we can also assist with you. For a non-audit client, our corporate advisory team can assist with these kind of valuation reports. And if for an audit client, we can provide you, we can refer you to someone that we work with on a regular basis to help you out. So we can always assist you with your needs in relation to this. So please feel free to reach out if you have any questions or help that you require. So I'll finish that. So you will get a copy of the slides as well, so you'll be able to have a read of these again. And again, as I said, if you do have any follow-up questions, please feel free to let me know. So just in terms of the provisional accounting, as I said, we do get 1 year to finalise this. So in terms of the changes that are permitted during the measurement period, we're allowed to modify the identifiable assets acquired and liabilities assuming any NCI. So that's what I was basically going back to in relation to kind of valuations of plant and equipment, intangible assets, etc. The consideration transferred from the acquiree, so we can also remeasure that during the year if we feel we've made, initially we've accounted for it at a different number of what it should be. And if the business combination is achieved in stages, that's also obviously needs to be updated throughout the measurement period. And then, so basically once we kind of get to a point where we finalised our accounting 12 months later, we just need to disclose that in the financial statements to confirm that it's been completed. Okay. All right, so the last bit I want to touch on just for kind of the last 5 minutes or so is just on the disclosures. So when you do a business combination, it does have quite a significant impact on the financial report for that year in question. I think, because obviously you're effectively impacting every single balance to a certain extent, then, it will flow through all your notes and disclosures and accounting policies. And also, obviously your review of operations in your director's report, which is also very important to get across any messages that you need to. Quite often when we do complete a business combination, initially it doesn't look like a great decision financially, because there are these transaction costs that you've got to expense, and you may have some kind of costs initially in terms of building in, getting your synergies and actual efficiencies which were the purpose of doing the combination in the first place. So you need to make sure in kind of your review of ops and director's report that you really get that across to the users of the financial statements, because otherwise, you can get kind of questions on it, at the AGM, such like. So I guess these are the key areas where it would impact, and I've already kind of touched on the director's report and review of operations. The other part here is the cash flow, and obviously investment, a completion of a business combination is an investing activity. So effectively, we would see a line in our cash flow statement which calls out the cash paid for business, net of any cash acquired, and that would be a former part of your cash flow statement. So notes to the financial statements where the assets and liabilities have been acquired. So one of the other key things to put in is really in your critical accounting estimates and judgments note, and to especially call out if you've just completed a business combination that you're still within your measurement period for the 12 months, and that you're still assessing the value of the assets and liabilities. Once you've completed your measurement period as well, you'd also want to look at having a critical accounting estimate and judgment in respect of kind of the carrying value of these intangible assets that you may have separated as part of from your goodwill. And then on top of that, there's obviously the business combination disclosures, which I've got an example of now, and they're basically in line with whatever's what's in AASB 3. And I'll show you an example here now. So this is an example which was released to the ASX last week. So hot off the press, this one. So as you can see here, firstly, we've got the date of the acquisition was completed and total consideration that was paid. We've also then got a listing of all the assets and liabilities that were acquired, and they've actually been, because it was done on the 27th of February, they've actually managed to split their intangible assets between software and customer relationships. We've also got a right of use asset in there as well, and that's an interesting one because obviously that's new for this year, the lease accounting. So we do need to bear that in mind now if we are completing business combinations. Are we taking on any leases, and should we have a right of use asset acquired as part of our business combination? I would imagine for kind of a lot of business combinations that are being completed now, that will be the case. So that's something to bear in mind because it's quite an easy one to miss if you don't pick that up. So you can see that the total assets acquired there are 2,685, and then the section below splits out the total consideration that was paid. So you've got your cash consideration there, net of the working capital adjustment, which we touched on. The shares issued on consideration as well. So this was obviously part cash, part shares. Deferred consideration shares, which is going to be paid subsequent, and that gives us our total purchase consideration. So you can see there, if you subtract the 5,465 from the 2,685, you get your goodwill balance, which is the 2,780. The other disclosures that you need to just kind of complete, as part of a business combination, is you need to explain what the goodwill's for. So most people would argue that when you do complete a business combination, it's expected synergies and other benefits from combining these assets. So that's basically the standard explanation, and it makes most sense. And we also know that the goodwill is not deductible for tax purposes in Australia. So it's not the case in the US, but in Australia it is. And obviously there they've noted that deferred consideration is expected to be settled in November 2020. As this was a June 20 report, it's still sitting on the balance sheet as a liability. You're also required to disclose the transaction costs, which you've incurred as a result of the acquisition, and they go through the P&L. Contingent assets and liabilities, we just disclose whether we have any or not. In this case, there aren't, which is fine. And then in terms of the profit contribution, we're supposed to denote the contribution from the date of the acquisition, and we're also meant to denote from the period from 1 July or the start of the financial year, as if the business combination was completed on the first day of the financial year. Quite often in practice, this isn't really practical. As I mentioned previously, it's quite often, when the acquirer purchases a vendor, it might be a much larger business acquiring a smaller business. The smaller business may not have been audited. They may not have the processes and controls in place that would, make it kind of efficient to go back and do this process. There is a get out in AASB 3, which basically says, if it's not financially viable to go and do it, or it's going to cost a significant amount of money, or other kind of qualitative and quantitative factors, which makes it really, really difficult to go out and do this, and you don't have to do it. It is so in this case, it hasn't been done, and that's totally in line with the standard, so that's fine. That was just about everything that I wanted to talk about today. So I think we're bang on time there on 45 minutes. So I've timed that quite well by chance. So I don't know if there's any final questions before we finish. I hope that was helpful, and it gives you an understanding of the updates to the business combination standards, how we account for it, and the required disclosures in the report. So unless there's any other questions, I'll just give a couple of minutes. One thing I would say is, this is the second webinar that we've done in the series, the first one being the impairment testing webinar that we did back in June. If there are specific topics, people are interested in or would like to kind of, do a session on them, please feel free to email me, and we can build that into the the program going forward. We're looking to do one kind of every couple of months. So we really do appreciate your feedback, and if you do have any feedback on the session as well, I would love to hear it, just to take that on board going forward. Okay, so I'll check, give it another minute just in case anyone's typing anything. I've got one. Customer lists and value. Yeah, okay. So value in the customer list. That's an interesting one. I think it really comes down to kind of expected sales. So effectively, to value that, you do, from my understanding, you would do kind of a discounted cash flow on expected future sales to these customers, and you probably have a kind of a churn rate. So you probably say, you know, after kind of, you do a discounted cash flow and you say after 1 year you might drop off, you know, 10%, and after year 2 you might drop off another 20%, and then you kind of get to the point where you wouldn't have a terminal value, because likelihood, you know, these customer relationships would probably potentially be gone by you know, 7 to 10 years later, so there wouldn't be a terminal value in the calculation, I wouldn't have thought. So I hope that's what you mean by that question. Hopefully I've answered that. Okay, so I think unless there's anything else, I think I really do appreciate everyone's time today, and you know, thank you so much for you know, attending, and stay safe everyone, and hopefully we'll be out of this lockdown in Victoria soon.